Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Tawfiq, and today we're going to discuss about accounting on Sukuk. Let's go. First, we're going to discuss about what is Sukuk. According to AAOEV, Sukuk can be defined as certificates of equal value representing undivided shares in ownership of tangible assets, usufruct, and services, or the assets of particular projects or special investment activity. Now you may be wondering the difference between Sukuk and bonds. The first difference is in the contract. Sukuk can be applied in various Sharia contracts, meanwhile bond is actually lending and borrowing transaction. The second one is return to investor. In Sukuk, there is a profit element in the underlying contracts, meanwhile bond is merely interest on loan. The third one is on the fourth. Sukuk are like trust certificates. Sukuk holders have ownership stakes in specific tangible assets. Meanwhile bonds are debt obligations due from the issuer to the investor. Thus, bondholders hold investment that offer fixed or variable rates of interest. The last one is in the sale. The sale of Sukuk represents a sale of a share of the specified asset. Meanwhile, the sale of bonds is basically the sale of debt. Sukuk normally issued using SPV, an independent legal entity created to fulfill narrow, specific, or temporary objects. The process of issuing Sukuk is as follows. The originator or the business firm requiring capital creates a special purpose vehicle or SPV, an independent entity and structures to issue the Sukuk. And then the SPV issues the Sukuk offering it for sale to investors with agreement spelling out the relationship between obligator and Sukuk holder. With the money from the sale of Sukuk certificates, the SPV passes offering to the originator who makes the Sharia-compliant asset purchase, lease, joint venture, or another Sharia-compliant contract. There are two kinds of Sukuk, asset-backed Sukuk and asset-based Sukuk. For asset-backed Sukuk, the Sukuk holders actually own a share of a specific tangible assets of the business. Thus, the originator's bankruptcy will not affect the Sukuk holder's right to the cash flow arising from that specific asset. Accordingly, the risk associated with the ownership of that asset will also be borne by the Sukuk holders. So, in asset-backed Sukuk, the profit return and return of capital are ultimately based on the assets. On the other hand, asset-based Sukuk are structured to replicate conventional bonds. Bonds require issuers to guarantee both fixed income as well as the principal amount of the loan to the creditors. Similarly, this debt-like structure is used to structure asset-based Sukuk by incorporating income and capital guarantees. There is no sale of the underlying asset of originator to the Sukuk holder. Therefore, an asset-based Sukuk structure, the overriding reliance of investor is on the credit strength of the obligor rather than the underlying asset. Sukuk can be structured according to various contracts. It can be divided into sale-based Sukuk, lease-based Sukuk, agency-based Sukuk, and partnership Sukuk. In sale-based Sukuk, we have murabahah or markup sale, istisna or manufacturing sale, and salam or forward sale. In lease-based Sukuk, we have ijarah muntahiyah bitamlik or lease ended with transfer of ownership, and ijarah mausufah bitimah or forward lease. In agency-based Sukuk, we have wakalah al-istihmar or agency for investment, and last one, in partnership Sukuk, we have musyarakah and mudharabah. Now we're talking about accounting and Sukuk. under IFRS. Under IFRS 139, Sukuk will be treated as investment categorized as follows. The first one is held for trading investment. This type of Sukuk held by a company for a short period of time. The Sukuk are primarily bought and sold for short-term gains and reported as their fair market value at the end of the financial period. Gains and losses will be included in the unrealized holding gains or losses in the income statement. The second one is available for sale investment, which is the default one. The main difference between trading and available for sale is the changes in the value of the Sukuk. As indicated earlier, the changes of value of the former are dealt within the operating income, while the changes in the value of the latter are accounting for other comprehensive income or OCI. Thus, the unrealized gains or losses in OCI are the short-term available for sale fair market adjustment. The third one is held to maturity investment. These are investments held by a company that intends to hold the investment to maturity. Such Sukuk will be recorded at cost. Gains or losses are only recognized when the company sells the securities. Held to maturity investment in the case of Sukuk are usually Sukuk Salam and Sukuk Istisna. These certificates are only redeemed upon maturity. Now we're talking about accounting on Sukuk under AAOIV. Similar to IFRS, Sukuk under AAOIV's FAS number 17 also classified into three broad categories: held for trading, available for sale, and held to maturity. Sukuk held for trading are acquired for the primary purpose of generating profit from short-term fluctuations in price. Sukuk held to maturity are those investments that has positive intent and ability to hold to maturity. Available for sale Sukuk are those not in the two categories just described. At the end of each accounting period, Sukuk held for trading and available for sale shall be revalued to the fair value. The unrealized gains or losses on Sukuk held for trading will be recognized in the income statement as unrealized remeasurement gains or losses, while the remeasurement at fair value of investment available for sale Sukuk must be recognized in the statement of financial position under the investment fair value reserve. However, Sukuk held to maturity are measured at historical cost, unless there is impairment in value. If there is impairment, the difference shall be recognized in the income statement. That's all from me. Thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh. Goodbye.